Would you like to get an interest rate significantly below market rates? And we told you earlier what the market rate is right now, according to our friends over at OBMMI. 6.574 is where the market is right now as we record this on, well, that's as of August 15th. So would you like that? Okay, let's talk about the workshop. So we're talking about a rate buy down, and most people, they don't understand rate buy downs. So we're going to give you a guide to finding the right one for you. That's, what's right for one person, it may not be right for everyone. Buy down is a way for a borrower to attain a lower interest rate by paying discount points at closing. Discount points, also called mortgage points or prepaid interest points, are a one-time fee paid up front. In the case of discount points, the interest rate is lower for the term of the loan. Does it work for all loans? VA loans, FHA loans, adjustable rate mortgages, jumbo loans, conventional loans, just about everything. It works for most all of them. We've done them for years and years. It's nothing new to us. So the types of rate buy downs, there is a temporary buy down. Temporary buy down is when a party in a mortgage transaction pays a lump sum to temporarily reduce the interest rate for the loan's early years. This can help a buyer ease into the local mortgage payment at the beginning of the loan term. There's also a permanent buy down. Permanent buy down mortgage has a lower interest rate for the entire life, the entire term of the loan. So if a borrower gets a 30-year fixed rate mortgage with a permanent buy down, the interest rate will be lower for the entire life, the whole 30 years of the loan. Okay, let's talk about the temporary buy down first. There's a 2-1 buy down, a 3-1 buy down. For example, a 2-1 buy down is a specific type of mortgage buy down that allows home buyers to save on their interest rate for the first 2 years of the loan. Buy downs can also use a 3-2-1 structure. So 3% in the first year, 2% the second year, 1% the third year, and then it goes to the fully indexed or the full interest rate. So one of the things there, so that money is all being set aside in an escrow account. You don't want to do it for yourself. You want to do it if you can get the seller to pay for that. Why? Because why would you want to have the escrow company holding your money for the next 3 years, giving you no interest, just prepaying your penalty? Put it into a savings account. You can do the same thing. Permanent rate buy down. This is a fixed term. Permanent buy down mortgage has a lower interest rate for the entire term of the loan. So if a borrower gets a 30-year fixed rate mortgage with a permanent buy down, the interest rate will be lower for all 30 years. Pros and cons of the temporary buy down. The pro, lower rate than the permanent buy downs. Unused funds are returned to the borrower or the buyer. The seller funds the temporary buy down. Cons, the downside, buyer can't qualify at the lower start rate. The offer is temporary relief in mortgage payments. The buyer would need to refinance if the market drops. Okay, what are the pros and cons of the permanent buy down? Well, the pros, number one, the rate is fixed for the life of the loan. The buyer can qualify at the lower rate. Directly addresses our housing affordability crisis because you've got a lower payment for the entire term of the loan. You don't have to worry about it going back up again. And if the market doesn't go down, you're going to be dealing with a higher rate down the road. Number four, the buyer doesn't need to refi down the road because they've got a good rate. Now, if the rates go down below that buy down rate, and I was just consulting with somebody over the weekend, their buy down number that we talked about is going to be in the mid fives. With them being in the mid fives, okay, now they're looking at, no one's projecting interest in the fives this year. I haven't seen anybody project it for next year. Maybe we're looking at 2027. I don't know. The buyer doesn't need to worry about job loss to lower credit scores and or lower values like they would with a temporary buy down. Downside, buyer might need to refinance if rates drop below the buy down rate. We've talked about that part of it. You may want to. Okay. So you want to keep those buy down options available. That's the whole key to it. And it creates affordability financing for all borrowers. That's the whole issue right there. Whoops, went too fast. Okay, so that's where we're at with that part of it. Okay, so now let's take a look at this one. Here's a real-time example that we're going to use right here. So we've got a $700,000 purchase price. That's our full price of the property that we're using in this hypothetical example. This particular family had 25% to put down. So they've got a loan for $525,000. I rounded off that interest to 6.5%, and we're looking at an APR of 6.581. Payment is $3718.25. Now, you can't do this when you're watching a video, but when we do custom analysis for people, we send this out on a dashboard, and the dashboard actually has an area where you can actually push this button right here that says more info. When you push that button that says more info, guess what you get? More info. And you can actually see the payment breakdown and the closing cost breakdown. But in the payment breakdown, you can see we're talking about principal, interest, taxes, insurance. And this happened to be a Washington property that we were talking about. So that's why the property taxes are lower than what you might see in California. So that's where we came up with that $3718.75 was that full payment, principal, interest, taxes, and insurance. So now what we're looking at is how do we create a lower payment? And in this case, the family's looking at it saying, okay, well, they said to me they wanted to stay below $4,000 a month, but we can do way better than that for them because we want to look at buying down the rate. This is in a purchase. So we say to the seller, or we say to the seller's agent, because we don't talk directly to the seller unless the agents want us to, but then we can consult with them. You know, we need some help. We're thinking about, we want our budget is $3,200 a month. How do we get there? Well, we could offer a price cut. We could offer a new price of $610,000. $90,000 as a rate cut on that. Do you think that's going to happen?
I got a bad feeling about this.
I don't think so. But that brings us down to our budget, $3226.56. But we had to keep the interest rate the same because all we did is offer to cut the price. What's a better way? Well, instead of a $90,000 price cut, what if we offered to get a $25,000 seller concession for recurring, non-recurring, and well, I'll give you that later too. The bottom line is you got to do it strategically. It's got to be put in the contract the right way, or it will trigger high cost and predatory lending violations. So we leave the purchase price at the full $700,000, still at 25% down, but now with that $25,000 concession, we can go to a 5.375 interest rate, 5.772 for those of you keeping score. Notice our payment is the same, $3226.56. Same number. We had at the full price, we had a 181 was the cash to close. We went down a little bit, $180,191 on our buy down strategy, our payment assistance. We're saving $492 a month. Massive savings, $492 a month. Now, the biggest question I get on a regular basis, Ron, what if the appraisal doesn't come in at that $700,000? Well, here's the story. We've got that covered too. What if the appraisal doesn't come in even at 610? What if it comes in at 607? Okay, now we've solved it. We're going to keep the loan amount the same. We're just going to change some of the back end numbers within the structure of that of the financing. Mortgage, the interest rate stays the same. All of the numbers are going to stay the same. The payment stays the same. Cash to close stays the same. The APR stays the same. Nothing changed on the appraisal gap. We just used different numbers for the finance structuring. We're going to ignore this column now from here on for the rest of our discussion, but that's the way these numbers work. Now, you want to look even further at the numbers, right? So we already talked about the fact that when we go and do these things, we've got a savings. And if you look at it, monthly payment, we already talked about is $492.10 is our down payment amount there. There we go. Okay. $492.10. Savings over 60 months over our full price offer. If we cut the price, which I told you that I don't have a good feeling about it.
Bad feeling about this.
We're going to save $21,000, almost $22,000 over the first 60 months. With the appraisal gap, we're saving $30,381 over that 60 months. 10 years, what's our interest expense? $341,000 full price, $297,000 if we get that price cut that
I got a bad feeling about this.
right, we don't think we're going to get. Or saving we're at $282,000. So we save, what's that, almost $120,000 in interest. No, I did that wrong. It's about $160,000 in interest by using the strategy that we're talking about. Massive savings right there. Now, I don't have to tell you, you probably want to save a lot of money, don't you? I mean, I don't know too many people that are not into that saving money idea, but I want you to realize why I say it all the time, that strategy beats rate always. Strategy beats rate always. And let's take a look and see if we go back. Why do we talk about this so intently? Because what I really want you to understand here, and I think I've got one more slide for you in our workshop. Okay, so we're creating affordability. That's what our whole idea is. Saving you money, creating affordability for all buyers. Now, why is that such a big deal? Well, right now there's a lot. Well, I told you in earlier that a lot of houses are falling out of escrow right now, a lot more than they had been previously. If you've got a problem that you're coming across, we have created our Second Look Advantage program. It's all part of this whole process. So if you've got a home that you really want, and you're saying, you know, Ron, I want to see if there's a better strategy. And they told me about doing this temporary buy down thing, but I just watched the workshop and you seem to be more in favor of a permanent buy down. And I am. Send us whatever documentation you have, your loan estimate that you've been given, and we'll just take a look at it. We'll tell you, are you getting the absolute best deal? Are you getting, and what I mean by that, rate, payment, is it meeting your goals and objectives? So we're going to give you a comprehensive review, ensures that you or your client, depending where you are, get the best available deal. We uncover any potential closing risks before they become problems. You know, I did my first loan in 1983. A lot of loan officers weren't even around then. And if you're going to the big banks, that's a biggie right there. They have only one product to offer, theirs. We often unlock more buying power. If you could afford that higher payment that we just talked about, what do you think would happen if you went to a $750,000 or $800,000 purchase price and used the same strategy to buy that rate down by the same $500? We specialize in finding the best that can be done, not just what's been offered. And I'll tell you what, if I cannot find it, my team can't find a better deal for you based again on the meeting your short and long-term goals, pricing, payments, you can't find a better deal, I've got a $100 Amazon gift card for anybody this month. Just throw that out there for you. We put our money where our mouth is. Now, if you want that buyer's guide, I'm just going to tell you right there, rsrlinks.com/buydown. rsrlinks.com/buydown. Again, rsrlinks.com/buydown.